Here is something strange. The US economy grew faster in 2025 than it had in 2 years. The stock market was up, corporate profits were healthy, AI companies were building data centers the size of small cities, and yet, 1 in 3 Americans said they expected their finances to get worse in 2026, the highest that number has been since 2018. Meanwhile, the chief economist at Moody's Analytics, one of the most respected forecasters in the world, sat down and said, quote, "Nothing else can go wrong." Like, nothing. We're pretty much on the edge. So which is it? Is the economy strong or is it teetering? The answer, and this is what almost nobody is explaining clearly, is both. At the same time, in the same country, for different people. And that contradiction is exactly why experts keep warning about 2026. To understand why 2026 feels so unsettled, you have to understand something that's been quietly true for a few years now. The American economy has split in two. Not split along party lines, not split by industry, split by income. The wealthiest 10% of Americans now generate nearly half of all consumer spending in the country. Half, which means the headline numbers, GDP growth, consumer spending, stock market performance, are, in a meaningful sense, a portrait of one slice of the country being projected onto all of it. For that slice, things are great. Asset prices are high, investments are compounding, AI exposure is generating real returns. For everyone else, Deloitte's consumer products chief summed it up bluntly. The bottom half of the economy is already in a recession to some extent. That's not a fringe view. That's one of the most cited consulting firms in the world, publicly saying that for millions of Americans, the recession isn't coming. It already arrived. Now hold that thought, because it's the foundation for everything that follows. Let's talk about what's actually been driving US growth. In the first half of 2025, investments in software and AI-related equipment accounted for roughly half of all economic growth. Not agriculture, not manufacturing, not small business, AI infrastructure. Analysts at Deutsche Bank said something remarkable. They suggested the US economy might already be close to a recession if you strip out tech spending. Think about that. The most powerful economy in the world is, right now, being held up to an uncomfortable degree by one sector betting on a technology that hasn't fully delivered on its promises yet. That's not a catastrophe by itself. Every era has its engine. The 1990s ran on the internet boom. The 2000s ran on housing. The difference is that we've seen what happens when the engine misfires. The AI bet might be exactly right. It might be transformative. The companies spending hundreds of billions on data centers might look like geniuses in 5 years. Or the market might be slightly ahead of reality. And if business spending on AI pulls back, even modestly, the math changes fast. Deloitte's economists actually mapped this out. They built a scenario where AI investment becomes, in their words, overdone, and companies pull back in 2027. Real business investment drops, GDP softens, the cushion disappears. That's the hidden risk in the headline numbers. The growth is real, but the foundation it's resting on is narrower than it looks. Here's where it gets interesting, because if you know what to look for, the dashboard has been flashing amber for a while. Start with the yield curve. It's the relationship between short-term and long-term US Treasury bonds. Under normal conditions, lending money for longer periods gets you a higher return. Obvious, right? But when investors get nervous about the near future, they pile into long-term bonds for safety. That pushes long-term yields down. Short-term yields stay higher. The curve inverts. The yield curve inverted in 2022. It has predicted every US recession since the 1970s, every single one. Now, the economy didn't collapse in 2023 or 2024 the way some expected, so some people called the signal wrong. But the rule isn't that recession follows immediately. The rule is that it tends to follow, eventually, usually within 18 to 24 months. The second signal is something called the Sahm Rule. It was created by a former Federal Reserve economist, and it works like this. If the unemployment rate rises half a percentage point above its 12-month low, a recession has almost certainly already begun. The Sahm Rule triggered in 2024. Again, the economy didn't crater, but unemployment has crept upward. It hit 4.4% by late 2025, the highest in 4 years. Federal Reserve Chair Jerome Powell publicly said that he believes payroll numbers have been overstated and that revised data will show the country has actually been losing jobs since April, not shedding them dramatically, not the shock of 2008, but quietly, steadily losing them. That's what economists mean when they say the labor market has entered a, quote, low hire, low fire equilibrium, stable on the surface, but the flow has essentially stopped. Now add in policy. In April 2025, the Trump administration announced a sweeping round of tariffs. Markets went into something close to panic. The phrase used, and this is almost too on the nose, was Liberation Day. The immediate concern was obvious. Tariffs raise prices. Higher prices mean consumers spend less. Consumers spending less means businesses earn less. Businesses earning less means layoffs. Layoffs mean less spending. And around it goes. The administration eventually walked some of it back. Exemptions were granted. Certain rates were reduced. Markets calmed down. The risk appeared to pass. But here's the wrinkle that most people missed. In 2025, a lot of companies did something smart. They stocked up. They pre-ordered inventory before the tariff rates fully kicked in. They essentially borrowed demand from the future. You can only do that once. In 2026, that buffer is gone. Companies have to deal with tariff costs at their current level with no runway to maneuver. Deloitte specifically flagged this. The average effective tariff rate in 2026 is expected to be higher in real terms than it was in 2025, not because the policies changed, but because the workarounds expired. And that feeds directly into inflation, which has been stubborn. Core inflation running at 3.6% annualized in late 2025, well above the Fed's 2% target, which brings us to the central bank and its impossible position. The Federal Reserve cut rates 3 times in late 2025, bringing them down to a range of 3.5 to 3.75%. Then it stopped. In January 2026, it held steady. That decision is more complicated than it sounds. Normally, when the economy slows and unemployment rises, the Fed cuts rates. Cheaper money means more borrowing, more spending, more hiring. That's the lever. But the lever only works cleanly when inflation is under control. Right now, inflation isn't under control. It's stuck above the target. The kind of inflation that comes from tariffs and persistent service sector price increases is particularly hard to fix with interest rate policy because it's driven by supply constraints, not just demand. So the Fed is sitting with its hand on a dial it can't comfortably turn either direction. Cut rates and inflation could re-accelerate. Raise rates and a weakening economy gets weaker. Hold steady and just hope nothing breaks. Mark Zandi at Moody's put a 42% probability on a 2026 recession. He noted that in a healthy economy, that number is usually 15%. JP Morgan put their estimate at 35%. RSM started the year at 40 and walked it back to 30. Bloomberg's surveyed economists settled around 30 to 40% in what is supposed to be a growing economy. To put that in perspective, flip a coin. That's roughly a heads or tails proposition for whether the largest economy on Earth tips into contraction. Here is where the numbers stop being abstract. The federal government is currently running deficits that would have been considered extraordinary by any prior standard. The national debt is large enough that the interest payments on it are now one of the biggest line items in the federal budget, competing with defense spending. In healthier economic times, deficits tend to shrink as tax revenues grow, but something unusual happened in the last 2 economic cycles. Even as unemployment fell and growth continued, deficits didn't narrow the way they historically would.
The structural gap between what the government spends and what it collects has become semi-permanent. Stanford's economic policy researchers flagged this directly in their 2026 outlook. The historical relationship between growth and the deficit has weakened, which means even a healthy economy isn't fixing the fiscal picture, and an unhealthy economy could accelerate it. Meanwhile, long-term interest rates have stayed elevated. The 30-year Treasury has barely dipped below 4.4%, which means any